In this lecture, we are going to briefly introduce the idea of econophysics and why we should care about it as traders. Econophysics, as the term clearly suggests, is the combination or intersection of the economic and physical sciences as a field of study with the goal of solving certain problems that arise in economic systems, like the nonlinear dynamics of price, for example. Economic systems are incredibly complicated, and it's impossible to come up with a fully objective model of how they actually work. There are good reasons for this. The Nobel Prize-winning economist Friedrich Hayek, one of the great economists of the Chicago School of Economics, pointed out that there is an inherent problem in the way information flows in economic systems, and this information flow problem makes it impossible to create a purely mathematical model of how economic systems work. In other words, we can understand concepts and ideas that affect economic systems in a broader sense, but we cannot fully roll back their internal chain of causality because of the nature of human decisions that form a market. For example, to come up with a full mathematical model of the economic system of an entire country, every single economic decision of every single person subscribed to that country would have to be taken into consideration, which is clearly impossible because economic decisions are the byproduct of human action, and human action is subjective by definition, and therefore impossible to be modeled mathematically. To clear any doubts about the subjectivity of human decisions, just think about trying to predict a conversation using a formula. It's impossible. You can make certain a priori observations about the topics of the conversation or where you think the conversation might go, but it is impossible to predict all the nuances and everything that is going to be said. The economic decisions of one single person cannot be fully mathematically predicted, let alone of millions of people together. The amount of information that must be taken into consideration is just overwhelmingly intertwined, complex and subjective. However, we know that certain ideas about economic systems produce certain results even though we don't know exactly how that happens in a purely objective way. For example, it's commonly accepted among people who understand the importance of pragmatism and the scientific method that letting the natural supply and demand mechanism regulate price is a better idea than artificially inflating or deflating prices in a national economy. That's why economic freedom makes poor people less poor, and overly centralized economies tend to end up in forced labor camps. Friedrich Hayek claimed that there is a kind of arrogance in assuming that a centralized government can plan the economy to the degree they think they can. This is what's known as fatal arrogance. The natural conclusion is that there are certain rules about the economy that, if respected, will generate the best results. Think about a soccer game, for example. We cannot predict exactly every single movement of the players, but we know that all players have to agree to certain rules that will make the game competitive and productive at the same time. Every individual is free to act within the framework of those predetermined rules and guidelines. It's also known that freedom is different than impulsive freedom. In a healthy economic system, people have the greatest amount of freedom within a predetermined framework that is designed to maintain things running smoothly without going to counterproductive extremes. Impulsive freedom is when there is no predetermined framework at all, and people can literally do whatever they want. This might be good in a first moment, and it certainly is in the very short term. However, the game of impulsive freedom becomes quite dangerous and totalitarian rather quickly, and there is no good that can come from such a game. The essential point here is that there can be a multidisciplinary approach to the study of economic sciences, and as a result, to the study of how financial markets really work. One of the ways to look at economic systems is through the lens of physics, and there is a logical reason for this as well. We already know that everything inside our universe is subjected to the laws of physics somehow. Apart from the incredibly small scales, which seem to be described by quantum mechanics, everything else is gauged by relativity. That includes everything in the natural world, since the most gigantic motion of galaxies and supernovae until the tiny synapse firings in the brain and microscopic chemical processes inside cells. The argument is that since economic systems are not only part of the natural world, but a byproduct of the natural world, they must be somehow subjected to the laws of physics. We have to be careful to interpret this last idea because a naive person could assume that you can predict the financial markets using the equations of physics, which is not the case at all. That's not possible due to the problem of information flow described by Hayek, among other reasons as well. However, just like we know that certain mathematical concepts have certain effects in economic systems, we can infer that certain undeniable axioms of physics can also be applied with the same effectivity. That means we can use physics to help us make economic decisions, although it's not possible to predict the market using a formula. The actual prediction of the market involves other specific trading principles that have nothing to do with physics. In this paradigm, we can arrive at the conclusion that we can indeed use physics as a tool to help us get a clearer view of price, and in this course, I hope you will become absolutely convinced that this is the case. The question of whether or not there is a connection between market logic and the laws of physics is a deep question. It turns out that there are fields of study like sociophysics and psychophysics, which attempt to model sociological and psychological phenomena using the undeniable axioms of physics. Once again, this idea is entirely predicated on the notion that everything subscribed to the natural world is somehow regulated by physics to some degree. The conclusion is that there might be some relationship between the laws of physics, the complex structures of the mind, and the reflections of these complex structures as well. The problem here is that the nature of consciousness is still an astounding mystery, and we cannot help but speculate about the intersection between physics and the mind. However, the mind seems to be the end result of a complex net of neurons that are deeply connected to one another. In fact, there are billions of connections in the human brain. This suggests that the mind as we know could be just the result of information processing in the brain, but just like we cannot know every subjective economic decision of every individual in an economic system, we cannot roll back the entire chain of causality of every synapse firing in the brain. The point here is that all the events that happen in the brain have to work under the fundamental axioms of physics. In other words, the cells in your brain are still subjected to the laws of physics. It seems logical to conclude that the reflections of the mind in its more complex forms are also subjected to the laws of physics somehow. Once again, you have to be careful here. This does not mean that you can predict synapse firings using the laws of physics. It means that synapse firings have to work under a certain physical framework, meaning that they cannot break the laws that govern the rest of the universe. That also does not mean that physics will be able to predict how synapse firings will happen. It's not a matter of prediction per se. It's a matter of description, and this description of the universe under the physical laws, which can definitely be done, can be used as a contextual element for financial speculation in a price chart. In the same way that we can use mathematics to describe certain economic events, we can use physics to describe them also. Once again, this is different than using a mathematical formula to predict the future of a system. This is especially the case when we have nonlinear dynamics, which is the case in the financial markets. To understand that, we must get a better idea of what nonlinear dynamics is. A linear system can be described by a mathematical formula because its underlying structure does not change. If you tried to do that with a nonlinear system, you would discover that the formula that describes the system would change from time to time. Beyond that, you would also discover that the frequency by which the formula would change would also be unpredictable. This is called the unpredictability of nonlinear dynamic shifting, and it's exactly what happens in a price chart. Here there is a point of contact between Hayek's information flow problem and the Bonini's paradox that we studied in the fractal flow strategy. The end result of the complicated net of economic decisions that we call market generates nonlinear dynamics in price action. The Bonini's paradox, which states that any formula that attempts to describe a complex system becomes less understandable as it becomes more complete, confirms the notion that the market is indeed complicated in way that Hayek pointed out. This also confirms the idea that predicting the market with a simple formula is a vain exercise. Nowadays we see programmers trying to solve this problem by introducing nonlinearity in trading algorithms through the structures of artificial neural networks. This fact also confirms what we talked about the Bonini's paradox because, at the most basic level, an artificial neural net is just a combination of zeros and ones, but the programmer does not know exactly what the neural net is doing. In that sense, a neural net is some sort of low-resolution black box because trying to create a high-resolution algorithm would collide with the Bonini's paradox. As you can probably tell, this is a discussion that can become too complicated and pointless for the goals of traders. Trying to look at the market in mathematical terms only can be a vain exercise in that sense. This is where the multidisciplinary nature of financial speculation comes to the rescue because we have other simpler ways to look at price action. One of these ways to see price is through the lens of physics, hence the main focus of this course on econophysics. In order to be able to understand price under the light of physics, we have to stop attempting to guess its internal mathematical chain of causality, and we have to start looking at price as a moving object in the chart. That's one very important conclusion, and the rest of the course is entirely grounded in that idea. As usual, I will try to show that this idea holds water in the practical examples of the course instead of asking you to trust me without any sort of evidence. To begin understanding how we are going to apply econophysics in the market, we must get used to the idea of seeing price as a moving object in the chart instead of an abstract entity. If we look at the price chart, we will observe two axes, and price can be considered an object that moves within these two axes. That's an important idea for us to understand the ideas about physics and how we are going to apply them in the charts. Imagine a car going down the street at 60 miles per hour. We do not have to understand everything about the car to describe and measure its trajectory using the laws of physics. That's more or less what econophysics is like in the market. We do not have to roll back the complete chain of causality that creates the market to measure its trajectory with the laws of physics. Traders do not really care about the internal chain of causality that creates the market. They just want to have tools that will enable them to profit in some way or another. The good news is that the tools of econophysics are more than enough for traders to achieve their goal of profiting in the market without worrying about the difficulties of nonlinear dynamics and the complex mathematical problems attached to it. These problems are interesting without any doubt, but they are useless if we want to be pragmatic as traders. In fact, the notions of physics that we will need to understand are very basic. We are going to use many different tools to determine the trend and the extremes of price action, which is our object of great interest. We are going to make a quick review of Newtonian physics, in particular the three laws of motion. Newtonian physics will be useful to determine the motion of buyers and sellers in the chart, why trends stop and start, and things like action and reaction, which is a good way of extrapolating the immediate future using the immediate past. We also will take an even briefer look at the conservation law and potential energy that will help us clarify some things about the pitchfork, which will be the flagship technique by a huge margin. From the introduction of the pitchfork and its many auxiliary lines, we will enter a brand new territory that attempts to shed some light in the relationship between price and the lines of a pitchfork, which is some sort of mystery to a certain extent. Newton's laws of motion, the conservation law and the idea of potential energy can be used in a rough sense, and they provide a certain framework for us to think about price, but they are not very specific to the task of trading. The pitchfork is the tool that connects the laws of physics to the practical aspect of what we want to do as traders in the price chart. In this lecture we are going to see how the first law of motion from Newtonian physics describes how trends work in a rough sense. Keep in mind that before jumping into the detailed explanations about how these laws will work in the practical sense of trading, we must understand how they work in a more abstract way. The first law states that if the net force applied to an object is zero, the velocity of the object will remain constant. This is basically the idea of inertia. If an object is at rest, it will stay at rest unless an external force acts on this object. In the same way, if an object is in motion, it will stay in motion unless an external force acts on the object. Newton's first law is the key to understand the overall idea of trends in the market. Let's take the example of an upward trend. Unless an external force like market manipulation or major news events acts on price, the upward trend has inertia. This is why the fundamental axiom of Elliott wave theory is wrong. The market must not necessarily have 5 waves up and 3 waves down. The market can have as many waves up or down as it wants. What determines the number of waves or market vectors is the market itself, not the overly specific rules of Elliott's theory. However, the wave theory has a trick to go around this problem, and it's based on retrospective determinism, which is good for the theory and bad for the trader who uses it. It's easy to make an analogy here. When the market is trending, we can say that it is in motion. When the market is sideways, we can say that it is at rest, although it's not that simple because movements are relative to their temporal perception. With that in mind, we can say that a trending market will tend to stay in trending mode, and a sideways market will tend to stay in sideways mode as well. We will return to this idea later in the course. For now, this is only a rough notion of how we can look at price as a moving object instead of an abstract mathematical entity. To sum up this first idea of Newton's first law of motion, we can make a few very simple statements by substituting the first law with trading jargon. When the market is trending, it tends to continue trending unless an external force acts to stop the trend. This force can be some sort of market maker or some major news event that resets price. By the same token, if price is going sideways, it will tend to continue going sideways until an external force acts to change that. There are no rules about how much time price should keep trending or going sideways. What's going to tell you how much time the market continues in either of those possibilities is the market itself, and not arbitrary rules invented by humans. In a way, the laws of physics describe how nature works instead of attempting to tell nature how it should work in the first place. Newton's second law of motion states that the rate of change of momentum of an object is directly proportional to the force applied to it, and this change in momentum takes place in the direction of the applied force. Once again, that makes perfect sense in the market. The force applied in question here is the amount of money being dumped in the market in one specific direction. If we have too many people buying the market, it will go up proportionally. The opposite is also true by deduction. That's an almost intuitive idea about the markets, and even retail traders have a rough intuition about this. If the market moves a lot in one direction, it's because there was a proportional force acting in that direction. The origin of this force is better measured in purchasing power instead of the number of people behind a movement. That should be clear to those who understand the purchasing power of market makers, for example. The Newton's second law of motion is important for us to weight market vectors correctly, and it also helps understanding the difference between major and minor flows. Smaller movements simply have less purchasing power behind them. By analogy, larger movements have more purchasing power behind them. That's why there is a hierarchy between major and minor flows, and it's wise to respect this hierarchy most of the times. We can also observe the second law of motion by observing the angle of market movements. Market vectors that have a steep angle have a lot of purchasing power behind them. By the same token, market vectors with low angles have less purchasing power behind them, generally speaking. The intuition you should develop regarding Newton's second law of motion is that the steeper the angle and the greater the distance traveled in the y-axis of the chart, the more purchasing power a market vector has. By deduction, the less steep the angle and the smaller the distance traveled by price in the y-axis of the chart, the less purchasing power there is behind the movement. These simple statements are also bounded by the notion that the distance traveled in the chart is proportional to the purchasing force behind price. Newton's third law of motion states that for every action there is an equal and opposite reaction. That's the law of motion that can get a little tricky in the markets because the actions of buyers in the past can produce a mirrored reaction of sellers in the future and vice versa. We will be able to observe that with clear lines on a price chart. It's important to know at this point that price seems to respect Newton's third law of motion, and we can indeed find this action and reaction mechanism, which is a great thing for us as traders. Let's take the simple example of a downtrend. The market edges of the recent past often create what we call the action, and based on Newton's third law of motion, we can expect to have an equal and opposite reaction in the future. These are called action and reaction lines, and they can serve the purpose of pointing out market edges, but they can also be very useful to display the underlying angle of a market. In that sense, we can use the action and reaction lines in non-equidistant form as well, but for the intents and purposes of this lesson, you should get used to the idea that a past symmetry in price can reflect a future symmetry in a way that optimizes the entry and exit points of our trades. Once again, this will become a lot clearer in the practical examples. Another very basic idea about physics that is important to us here is the law of conservation and potential energy. The intuitive and easiest way to understand this idea is to remember that nothing is ever created. Everything is transformed. For example, when a car is at speed and it starts to deaccelerate due to braking, kinetic energy is transformed into thermal energy in the brakes. When a bomb explodes, chemical energy is transformed into kinetic energy and thermal energy as well. Here we have to talk about potential energy, which is the potential that objects have due to their relative position to other objects or types of forces. In the market, when buyers are producing kinetic movement in a price chart, the sellers are automatically building potential energy and vice versa. The potential energy accumulated is later exhausted into kinetic motion, and this is the key point to understand a pitchfork. In an uptrend, the potential energy by buyers is greater than the potential energy by sellers, and that's why the market rises. In other words, both buyers and sellers accumulate and exhaust their energy in an uptrend, but buyers accumulate more, so they can exhaust more as well. This is potential energy being transformed into kinetic energy in the charts, so according to the law of conservation, nothing is being created here. It's just a transformation between different types of forces that exist in the market. The fact that it is a transformation is key because that means we can make projections about the future exhaustion of energy using the past potential energy. In other words, what a pitchfork will do is to measure the potential energy in the past and project its probable path of exhaustion in the future. That can give us very precise points where price is likely to reverse because its energy will be exhausted. However, in the market it's not that simple because we have external forces acting on the system at the same time that it accumulates and exhausts energy. This is one of the origins of the techniques related to frequency shifting of lines, which are the most sophisticated, advanced, and precise in terms of technical analysis. We will take a look at these sophisticated techniques in the course, but for now let's focus on the first principles. It's important to understand that these things are not arbitrary. They describe the way the world works in an undeniable way. For example, if you hold an anvil at 10 meters from the ground, it has one potential energy. If you hold it at 20 meters from the ground, it has another. 1 kilogram of dynamite has less potential energy than 10 kilograms of dynamite. When you fill the gas tank of your vehicle, you are filling it with potential energy that will be later transformed into heat in an explosion inside the engine, and this explosion will be turned into kinetic motion in the pistons. That makes your car move, roughly speaking. I'm obviously oversimplifying, but a car only moves because potential chemical energy is transformed into kinetic energy. This would not be true if the law of conservation and potential energy did not hold water to reality. This is an essential point that must be stressed more than once. The laws of physics are an accurate description of how reality works. They are not the arbitrary invention of someone. They are not an invention. They are a discovery. Unlike the Elliott wave theory, for example, which is the arbitrary intellectual product of anecdotal evidence. It's not difficult to see that a theory that describes the way the universe operates is miles ahead of a theory that attempts to tell how the universe is supposed to behave in the first place. The arrogance of the second is just so overwhelming that it sometimes blinds people. Notice the difference between an invention and a discovery. A discovery is much more profound because it relates to an inherent feature of reality that was just waiting to be found. A theoretical invention is just rationalization taken to extreme degrees. In this lecture, we are going to study how we can approach the market in order to determine its trend. As it is usually mentioned, determining the trend of a market is quite useful because trading with the flow of the overall trend is a lot easier than trading against it. To begin understanding how to read the markets and the proper way to establish the trend, we need to grasp the concept of market structure. The market structure is composed of undeniable facts that a trader can read on a price chart. These facts relate to relationship between buyers and sellers in the market. The fundamental unit of measure of market structure are the market vectors. In other words, the vector between a high and a low or a low and a high. When we look at the charts, we can observe a series of market vectors and determine that they form patterns. For example, when price makes higher highs and higher lows, we observe the market vectors stair-stepping up. If we look at this idea more closely, we can see the logic behind this intuition of uptrend that comes from higher highs and higher lows, and also the intuition of a downtrend that comes from lower highs and lower lows. We can view the highs as the ultimate attempt of buyers to drive the market up, and the lows as the ultimate attempt of sellers to bring the market down. In an uptrend, the buyers are stronger than sellers, so they can produce higher highs. In a downtrend, the sellers are stronger than the buyers, so they can produce lower lows. That's an incredibly simple idea, but that's the fundamental nature of how price behaves on a chart. However, as you are about to find out, simple does not necessarily mean easy because of the fractal nature of the markets and the inherent level of complexity attached to the chain of causality of price. This complexity begins to show its face when we first recognize that there are multiple types of players in the market. In other words, there are traders with different amounts of capital power looking at the charts in different timeframes. This variation is what makes the simple mechanism of buyers and sellers complicated to observe sometimes. The problem is that we can usually see different herds of market players in the same chart. This brings us back to the notion of the flows in the market. In one single timeframe, we usually can observe at least a major market flow and a minor market flow. This touches in one of the hardest problems of trading, which is identifying where these flows shift and the hierarchy of power between them. Remembering that fractal means pattern that repeats inside itself, we can try to identify different market flows in the same timeframe. This is where the principle of subjective interpretation of market comes into play. Two different traders counting major and minor highs and lows on a chart might arrive at different conclusions about which highs and lows belong to the major flow and which highs and lows belong to the minor flow. It's important to notice also that there is a hierarchy of power between the major flow and the minor flow of the market. This relationship is mediated by what we call market memory, which is how much past information the current market remembers and respects. This is relative to the timeframe under analysis, of course. That's a tricky part of analyzing market flows because sometimes the minor flow will have more power than the major flow, and that is due to the interference of market memory. This is a situation that many traders have experienced in one way or the other. For example, imagine that you build a context for your trade idea by looking at the most obvious highs and lows on the chart, which usually come from the major flow. When price finally arrives at the place you were expecting it to have one type of reaction, you get caught by surprise because the market is the exact opposite of what you predicted. The reasons for this is the lack of attention in the minor flow and the failure to understand that the highs and lows you have used to form your context are not part of market memory anymore, so the minor flow seems to win over the major flow. Once again, understanding this subtle flow-shifting nature of the markets is one of the most challenging aspects of trading, and it is also a critical one. The identification of a flow shift in the market depends on several contextual factors, so the better you are at building trading contexts and reading the market organically, the better you are going to be at identifying these subtle flow changes. Another critical aspect of market structure is the notion of confirmed market structures and fake market structures, which recognition depend entirely on the candlestick reading of the highs and lows. This is also paramount to understand because most of the times, we will use only confirmed market structure to place our stop-loss orders. The logic behind that is quite simple. A confirmed market structure, as it was alluded in the beginning, is an undeniable fact in the charts. For example, a low is only confirmed when price surpasses the last high. By the same token, a high is only confirmed market structure when price surpasses the last low. That's fine, but there is a very important catch here that adds another layer of complexity to this story. Sometimes, price surpasses the last high or low, but it doesn't close above or below it. In other words, price only pierces the level in which a market structure would be confirmed. This is often the work of market makers who are attempting to employ their manipulative maneuvers on unadvised retail traders, which is a deeper subject that is outside the scope of this lecture and it will probably be explored in another video course. That brings us to the notion of fake market structures, which is when price only pierces the level that is supposed to confirm the last high or low. As the name suggests, we cannot rely on these types of structures as a solid place to put a stop-loss order because most of the times, these fake structures are made to be broken, so putting a stop-loss near them is a bad idea. By now you must be able to recognize that the simple mechanism of highs and lows in the market creates a few challenges that are not so simple. We need to pay attention to the different flows of the market and the points where they collide. We need to make the correct judgments about the hierarchy between the major and minor flows, and we need to classify the highs and lows of the market between confirmed and fake market structures. Keep in mind that in this lecture, we are only exploring the conceptual part of what we should be paying attention to in a chart. It's difficult to condense all the nuances of the practical application of these ideas into their purest forms because the markets have many different scenarios, and these ideas happen in many different ways. Once again, the best way to study these things is by observing the way they happen in real charts, which is what we will do in the lectures that contain trading examples. The pitchfork, also known as the median line, was developed by an MIT physics professor called Alan Andrews. Andrew's goal was to develop a tool that would enable him to predict the fluctuations in the price of stocks and commodities. The main idea behind the pitchfork is the law of conservation and potential energy. In theoretical terms, what a correctly drawn pitchfork does is to measure the potential energy of the past market and to project its probable path of exhaustion in the future. The pitchfork achieves this by displaying a geometrical relationship between three alternating market extremes, and this relationship usually provides a specific market angle with specific line edges attached to it. This angle is extrapolated into the future, and all three axes of the pitchfork extend lines respecting this angle. There are many details to pay attention to regarding the relationship between price and these lines. There are also many types of pitchforks that can be used in different situations. The ultimate goal of a pitchfork is to display possible market edges based on the immediate past. That's obviously very useful for any trader. Let's see the prerequisites to draw a pitchfork in the correct way. To draw a pitchfork, a trader needs three alternating highs and lows. That means a high, a low and a high for a downtrend, and a low, a high and a low for an uptrend. The market extremes must always alternate like that, otherwise the pitchfork cannot be drawn. To draw the pitchfork, you will need to choose three market extremes in the chart starting by the A pivot, then picking the B pivot and then moving to the C pivot at last. You must always draw forks in this order. Once you draw the pitchfork, you will see three lines on the chart. Let's break down what each of them do and what each of them mean. The line in the center of the pitchfork divides itself into two sections. The tail and the center line. The tail originates in the A pivot, and its relationship with the B pivot and C pivot is what determines the particular angle of the pitchfork. As we are going to study in the future, we can tell a pitchfork has a stronger validity by looking at frequencies along the tail. That's one way to tell if the pitchfork is going to remain useful in the future. Following the same angle, we have the outer lines of the pitchfork who come out of the B and C pivots. These two lines represent the future projections for the market extremes, although it's not that simple because we have to pay attention to a few key relationships between price and these lines. These meaningful lines act like magnets for price. In other words, these lines can attract or repel price, which is a good thing because it makes this relationship more obvious, and therefore, more predictable. The outer lines of the pitchfork are also important to derive the auxiliary toolset that is composed by things like sliding lines, double lines, overthrowing, and underthrowing lines and so on. In the pitchfork we also have a subtler line that is not so useful most of the times, but it can help us validate a pitchfork before price tests it. This is the BC line because it runs from the B axis to the C axis. Observing how this line cuts through price action can indicate the symmetry of the pitchfork. Another way to look at how pitchforks interact with price is by looking at their relationship with market vectors. For example, a pitchfork requires two alternating market vectors to be drawn. The main purpose of the fork is to project the probable point of exhaustion of the third alternating market vector in the near future. In that sense, the price information from the A pivot up to the C pivot of the pitchfork represents the measurement of potential energy in the market. The point from the C pivot onwards represent the projection of how the energy accumulated between A and C will probably be exhausted. The other major goal of a pitchfork is to pinpoint angled market edges based on the geometrical relationship between the three main axes. That's what gives traders the possibility of entering incredibly precise trades near the absolute reversal points of price. In summary, the pitchfork has two major uses: the visualization of the probable path of exhaustion of price and the identification of edges both for entry and exit points. You can also look at a pitchfork as a special type of channel, although the fork is a much richer tool with more capabilities than a normal channel. Forks are also known to be the only actual leading technical tool, meaning that it is the only tool that can completely remove the lag out of the analysis. It is a precision tool that will open your eyes to the subtleties of price action in a completely new way. As I said previously, there are different types of pitchforks that fit different market scenarios, and there are also auxiliary lines that can be added to increase precision and enrich the analysis. We have the standard pitchfork, the modified pitchfork, the width pitchfork, the reverse pitchfork, and the pendulum pitchfork. These are the 5 types of forks that can be drawn in a price chart. Pitchfork types can also be divided into major and minor forks in analogy with major and minor flows. Beyond that, we have the auxiliary lines that can be drawn in any of the 5 types of forks. These auxiliary tools are the sliding lines and the double lines. The sliding lines can be underthrowing or overthrowing inside and outside the pitchfork lines. As you can notice, there is a wide range of tools, and the possibility of different drawings on the chart is immense. That's a blessing and a curse at the same time, because just like we have a wide range of tools to be precise, choosing the correct lines to draw and trust can be a problem. However, I developed a technique to solve this problem. It's called the reverse engineering of market contexts that will be explored in another lecture. Let's first explore the different types of pitchforks and how to draw them correctly, and then we will move forward to the auxiliary tools. The standard fork is the one we learned how to draw in the previous lesson. We need 3 alternating market extremes to draw this fork. For upward forks, we need a low, a high and a low. For downward forks we need a high, a low and a high. This is the type of fork that is used most of the time. One important thing about these forks is that they tend to work better if they are not inclined more than 45 degrees in relation to the x-axis of the chart. In other words, if you draw a pitchfork that is too steep, it tends to be less effective. It was based on that problem that the next type of fork was developed, which is the modified pitchfork. A modified pitchfork is drawn when a standard pitchfork is too steep. In order to draw a modified fork, we have to be aware of the internal segments of the fork, especially the AB line. You can draw a modified fork by drawing a standard fork first, and then bringing the A-axis to the midpoint of the AB segment. That movement retains the symmetrical relationships of the 3 alternating pivots, but it decreases the angle of the pitchfork, so it falls within the optimal range of 0 to 45 degrees. One interesting thing about the modified fork is that we can arrive at the same modified angle by connecting the A and C pivots of the original standard fork. In other words, the AC line of every standard fork reveals the potential modified fork angle within those 3 alternating pivots. That happens because the standard and the modified forks rotate around the C-axis. Next we have what's called the pendulum pitchfork, which is exactly the same as a standard or modified fork. What changes is the purpose of this pitchfork, which is to catch where a retracement is going to end. Technically speaking, a fork is used to visualize the extension of a trending movement. In other words, in an uptrend there will be upward sloping pitchforks generally speaking, but the pendulum forks will be sloped downward because they will be used to catch where retracements will end, and trending movements start. In other words, in an uptrend there are up-sloping standard and modified forks and down-sloping pendulum forks. In a downtrend there are down-sloping standard and modified forks and up-sloping pendulum forks. Next we have the width pitchforks, which is a rarer type, but it is still useful to know how it works and why it's useful. Oftentimes, you will draw a pitchfork and price will sort of drift away to the territory outside the fork. The width pitchfork is drawn by adjusting the C pivot to the outer point of this drift. This pitchfork is especially useful when we want to use the centerline as a target for a trade. The width pitchfork can be very accurate in that sense, although there are other ways of seeing the same lines using standard forks and some auxiliary lines. This is something that will become clearer in the practical examples, so don't worry if you don't quite understand it yet. The last type of pitchfork we are going to see is the reverse pitchfork, which is also not very common in practical application, but it has an interesting idea underlying it. You draw this fork in the exact same way that you would draw a standard fork. However, the A-axis of the reverse pitchfork must be placed after the C-axis, hence the name of the fork. In order to do that, you have to let price create an extreme inside the standard pitchfork, and then you tune the centerline of the standard fork to that extreme. This will produce an angle as if the A-axis was placed in the price extreme after the C-axis of the pitchfork. The idea behind the reverse fork is that price will change its frequency after the C pivot, so the reverse fork would be an update of that frequency. That's an interesting idea that will be explored in the technique called frequency shifting, which is an extrapolation of this idea about the reverse fork into all of its components. Let's now move on to the auxiliary toolset of pitchforks. The auxiliary toolset has 2 underlying principles, which are Newton's third law of motion and the idea of frequency shift that gave birth to the reverse fork that we just saw. A frequency shift in the context that we are describing in here is when price falls short or exceeds one of the lines of a fork. That will become clearer in just a second. Newton's third law that states that every action has an equal and opposite reaction is what enables us to use the frequency shifting of the past to project a probable frequency shift in the future. The combination of these two principles give rise to the idea of sliding lines, which are lines that extrapolate extremes of price after the C-pivot of any pitchfork at the same time that it respects the angle of such fork. When price falls short of a line, we tend to call that an underthrow. When price exceeds a fork line, we tend to call that an overthrow. Following Newton's third law, an underthrow in the past tends to produce an overthrow in the future in one of the lines of the fork in question. The opposite is also true, of course. It's also possible that an underthrow ends up generating another underthrow, and an overthrow ends up generating an overthrow. That would fall more into the category of frequency shifting instead of a pure application of Newton's third law of action and reaction. The use of sliding lines along with pitchforks is extremely common, as you will observe in the practical examples. The other auxiliary tool that we will look into is the double line, which is actually very simple. Every pitchfork generates 3 lines, and therefore, 2 zones between these 3 lines. These zones are equidistant in the y-axis of the chart. A double line is when we add more lines respecting this specific distance generated by the 3 alternating price extremes that give rise to the fork. This is purely based on Newton's third law of motion as well. These are the types of forks and their auxiliary lines. As you can observe, there is more to these tools than what meets the eye, and mastering their use requires effort and study because they can appear in many different ways and market scenarios. In this lecture we are going to talk about an incredibly powerful concept that will open your eyes to all sorts of details in price action that most traders simply don't see. The reasons they don't see such details is that they are not aware of the idea of frequency in price action. Most traders are worried about finding a good moving average value or observing how raw price action interacts with tools in that class. Instead of looking at how price interacts with shallow tools, a trader should observe how price interacts with itself in particular ways. Without getting too philosophical about the idea of frequency in price action, we must approach this concept with the notion that frequency can be defined as the rate at which something occurs. With that in mind, we can say that a frequency line is a line that catches the rate at which something occurs in price action. This is a powerful idea because these frequencies can show specific angles or levels in price that cannot be derived in any other way, roughly speaking. In the particular case of price action, we are specifically interested in the frequency of candlestick tails. The reason for that is that candlestick tails hold a lot of information about the internal chain of causality of candlesticks. As limited as that source of information can be, that's the best we can do in a price chart, and it's amazing how precise this idea can be in reality. The idea here is that we want to catch the underlying frequency of a series of candle tails. There are 2 ways of doing this. The first way is catching this frequency with a horizontal line, and the second is catching this frequency with a sloped line. Let's begin with the horizontal line first because that's the easiest one to learn. To catch the frequency of a series of candlestick tails, you have to tie all of them in a way that the frequency line does not surpass the open or close values of the candles in question. Notice that this line points to a level that is different than the absolute extreme. To draw a sloped frequency line, you have to use the same idea, but with the added rule that the line must tie all candle tails in question in an angled way. These frequency lines are very useful to pinpoint precise reversal points in the immediate future of price. If you combine them with other ideas like press zones, normal buy or sell zones and things like that, you will have a good set of precise tools to trade near the edges of the market. Notice how both the horizontal and the sloped frequency lines catch all those candlestick tails by pinpointing what they have in common, which is very different than linking 2 market extremes together. This requires some practice, but once you learn it you will not be able to not see these lines anymore, which is a good thing generally speaking. If you have never heard about the techniques you're being exposed to in this course, you might be thinking they must be the ultimate solution to precise trading, and they are to a certain degree, but there is still a missing link that most traders who use such techniques simply gloss over. It's one thing to find the underlying frequency of a market or to make certain symmetries in price obvious. It's another to update these frequencies in real time to pinpoint the most precise entry and exit points you'll ever be able to spot in price. In other words, you not only have to identify the symmetries underlying price action, but you also have to update them as they change. That's certainly a challenge because the symmetries in price change in a nonlinear fashion as you would expect since price is nonlinear. The means we possess to see these nonlinear frequency shifts in real time relies in the spatial-temporal relationship between pitchforks and raw price action. One good example is to observe how underthrowing and overthrowing relationships play out. This is another way in which Newton's third law of motion is applied to price action. An underthrowing action in the past tends to become an overthrowing reaction in the future. That's the most common application, but we can also find an underthrowing action becoming an underthrowing reaction or an overthrowing action becoming an overthrowing reaction. Another face of this situation is the pure idea of frequency shifting where whole sets of lines are shifted considering the first interaction of price after this set of lines is drawn. This is much easier to observe in action than to explain in pure words. Newton's third law is what makes all of this somewhat predictable, and if we are going to assume that physics indeed describes the movement of price, then we can certainly count on this type of study. The idea of frequency shifting is the perfect marriage between econophysics and a cognitive bias that is usually seen with a bad connotation, which is the hindsight bias. Analyzing price charts in hindsight can be a good thing if you know what you're doing, but it is usually a bad thing because there is a specific process to hindsight analysis, and this process is usually not respected. The problem with hindsight is that it is a hardwired cognitive bias, which means it is automatic, or involuntary if you will. When you open a historical price chart to analyze what happened and what you could have done about it, your view of the market is already completely contaminated by the outcome of what you're analyzing. If you see price rising, you will tend to look for clues that will lead you to conclude that you would be able to see the elements of price that led to its rise while completely ignoring the elements that could lead to a short trade. This is just biased thinking. The correct way of performing a hindsight analysis is to be aware that such a thing as hindsight bias exists. That way you can purposefully look for both types of elements and clues in the chart to see what you really could have done if you were in front of the chart in real time. You purposefully have to create a compelling case for each side of the market and in different places probably, and then you have to decide which one of these cases is contextually stronger, which is not as easy as it sounds. However, we tend to think about hindsight analysis in a rigid way, meaning that if we look at the past, we will be subjected to this unfortunate bias, and if we look into the future, it's impossible to be subjected to it. I would argue that there is a sort of a middle ground that happens in real time, and this is precisely where the frequency shifting concept dwells. Imagine that between the past and the future of price we have a moving window that we could call the present. We can arbitrarily define this window and call the immediate past and immediate future part of the present. The elements of the frequency shifting usually happen within this moving window, and we need to curve fit our lines in this window to make more accurate projections in the future. This would be the optimal application of the hindsight bias. In other words, this would be like taking the negative force attached to this bias and turning it into a positive light into the future. This is one of the very few situations where we can turn a negative bias into a productive apparatus for market forecasting. As you will see in the practical application of these trading techniques, this is the highest peak in technical analysis. This is the most accurate you can get with any tool that you will ever use, and we can make such statement with good confidence because sometimes it's literally impossible to be more accurate. In other words, sometimes you can trace the absolute beginning of a market vector and the absolute end as well. We cannot be naive to think that this will be a constant in all our trades, but once in a while you will be able to make incredible projections. Most of the time, what you can expect is that these lines and techniques will be more than enough for you to trade with good risk-reward ratios, which is our pragmatic goal to begin with. We look for sustainability before we look for peak performance. Let me demonstrate the frequency shifting concept in its abstract form, so we can understand it better when we go through the practical application lectures of this course. We can usually define market angles by connecting two market extremes that seem to be important. That will create a projection line, and we expect that price will behave in a predictable way around this line in the future. You will often notice that when price returns to such lines, it will pierce it or poke it without violating the line with the candle body. The delta between the tip of the candle tail and the original angle line is the frequency shift that we have been talking about. It means that price is still respecting the angle that was previously highlighted, but the fine frequency of that line has changed a little bit. We can use that as a sign to project the next market movement by applying Newton's third law of motion to price. Since price has shown an overthrow in the lower line, it is likely to produce an underthrow in the upper line. As I already mentioned a few times, this alternation between overthrowing and underthrowing lines is not always the case. Sometimes the market will expand by showing just overthrowing frequencies, or it will shrink by showing just underthrowing frequencies. The lines that we are going to use depend on the series of contextual elements that come from techniques transcending the lines. That's why it's so important to have a multi-layer vision of price action. Using just lines to trade is a comfortable idea, but it is not enough to trade consistently over time. We must always employ contextual analysis to our trades to achieve acceptable results. This example we saw is just one of the many shapes and forms that frequency shifting can occur in the market. This principle of shifting can be applied to any type of line, including horizontal lines and pitchfork lines as well. As I said previously in the video, this technique is a new way of using the hindsight bias to view the present price action in a new light. Keep in mind that understanding frequency shifting is not a requirement to trade successfully. This is just a refinement tool. When I point out the relationship between price and meaningful lines, I'm talking about the sort of lines that display the non-obvious symmetries of price, like pitchforks, its auxiliary lines and frequency lines. This is somewhat of a paradox because price will behave around these lines as if the whole crowd that forms the market could see them, but at the same time, we know that most of the market cannot see these lines at all. The only explanation for that paradox is that price respects the mathematical and physical frameworks of nature independently of market logic or folk wisdom about technical analysis, and that's an important idea to validate the use of econophysics in trading. This is the opposite of attempting to trade with common tools about technical analysis. For example, if you plot a 20-period simple moving average on your chart, and expect that price behaves in a certain way in relationship to this moving average, you are assuming that the crowd of traders that form the market are going to behave in unison when price does certain things like touch the line or cross it. That's the usual excuse people use to justify a moving average on a chart. The comical thing is that most of these people usually have no idea how a moving average is calculated, and perhaps most importantly, they don't stop to think about why someone would attempt to smooth price with a moving average in the first place. It makes absolutely no sense whatsoever. Tools like moving averages are the exact opposite of what I call meaningful lines because they attempt to linearize a nonlinear dynamic. There is no good that can come from this because it is impossible to find a suitable linear solution to a nonlinear problem. There are exceptions to this problem regarding technical indicators, of course. Sometimes the faulty aspects of a technical indicator can become its biggest strength, ironically. That's the case with the whole idea of fractal candles, for example. It's a fortunate accident of mathematics. When a naive trader plots moving averages on a chart or technical indicators who have scientific-sounding names with pretty colors, you can be sure that most of the times, these people have absolutely no idea what they are doing. This is the problem of thinking through diffuse and superposed images instead of thinking through facts. Traders like these have a vague and rough intuition that there is something about these shallow tools that will be able to give them an edge, but they are not certain what it is. That's just not useful. One of the things that will become clearly noticeable to you after you learn the advanced types of lines is the fact that there is almost an infinite amount of good lines that you can draw. This produces a problem because it can be difficult to decide which of these lines we are supposed to use. The solution to this problem is something called the principle of reverse engineering of market contexts. If you think about this for a moment, you will realize that a good market context always leads to a place in the chart where several techniques converge. In order to choose what lines you are going to actually use in your trades, you have to pay attention to areas in the recent past and in the immediate future of price where lines and techniques converge to the same point. Combinations of lines and techniques that have been working in the past tend to continue working in the future, roughly speaking. Don't forget that this is a general guideline. We have things like frequency shifting to make our lives a little more difficult in trading. The conclusion here is quite simple. We determine the combination of lines that we are going to use by reverse engineering the possible market contexts that will be attached to them. In practical terms, this means that we should use different lines and techniques that seem to be working together. The reason for that is what I call the nudge hypothesis. As I often say, no single technique is capable of producing consistently profitable results in the long term. There are complicated reasons for that, but mainly it's because price action is a multivariate entity, and believing that a single one-dimensional technique is going to solve this problem is not only too bold, but also a quite dangerous idea. The conclusion that follows from this situation is that the optimal way of finding high-quality trades happens when multiple techniques converge to the same place in the chart. Each single technique in the market has a specific set of traders who follow and believe that particular technique. When we have one technique alone, price action might be affected a little bit, but not enough to produce an actual price reversal. However, when we have several techniques all at once, we have various sets of different traders in unison. That's what usually nudges price action into creating a significant price reversal. This is just another good argument to use contextual trading in its complete form. Some of you might feel that I stress this too much, but I receive emails on a daily basis with students who fail to consider contextual analysis even after being exposed to the idea constantly. The reverse engineering of market contexts and this nudge hypothesis are just another perspective on the importance of contextual trading. One of the problems in price action reading is that some traders believe they know how to do it because they learned some sort of pattern with a fancy name. I believe price action reading goes way beyond that, and I developed a theory to explain this depth I'm referring to. I usually compare learning how to read price to learning how to read a text because there are some similarities in both tasks that help us understand the kind of approach traders should have towards price action. The first similarity I would point out is not so much related to a text per se, but to language in general. For example, you cannot learn how to speak German in a week. That's because you have to memorize a whole vocabulary, several grammatical rules, many particular nuances, and perhaps most importantly, you have to practice all of this a lot until the German language gets sedimented in your brain. That's the only true way of making a foreign language become second nature to you. You should view price action as a language as well, and you should treat it with the same respect, although it is not nearly as difficult as German. Thankfully, price action is a simpler language, but it is indeed a language that must be learned. You cannot simply use tricks to read the language of price in the same way that you cannot use tricks to speak any other language. It's not even a solution on itself. However, since most people don't think about price in this way, they believe they can get away with tips and tricks in the market. The second thing we should pay attention to is the similarity of price action with an actual text. To understand that, we must become comfortable with the idea of low and high resolution views of price and texts. A low resolution view is the one that englobes the bigger picture and ignores the small nuances. That's an inevitable trade-off. As you increase the level of resolution, you tend to see more of the small details, but as a consequence, the notion of the bigger picture starts to vanish. Before using a more complicated example, think about a child drawing a helicopter. That would be a very low-resolution representation of an actual helicopter, but nonetheless, you can understand it is a helicopter because it displays the most important elements of the object. However, nobody would expect it to fly. In some sense, you understand that the child's drawing is a helicopter, but in the back of your mind you also understand that it is a caricature of the real thing. Now imagine a real helicopter being taken apart by a mechanic. That would be a high-resolution image of the helicopter because the level of detail is just overwhelmingly greater than the child's drawing. In both situations you see helicopter, but the level of resolution in both is tremendously different. This whole dynamic in the level of resolution that we see relates to the problem of perception in human beings. You can see the helicopter in both situations because we actually see the use of something before we see the actual object. In other words, we see the utility of something, and then we infer the object. That's counterintuitive, but that's the way things actually work. For example, when you see a hammer, you're not actually seeing a hammer. You are seeing the utility of the hammer. The actual hammer comes second. That seems weird, but that can be proven by the fact that blind people can detect certain types of facial expressions. That's because the overall shape of a facial expression and its recognition is deeply ingrained in our biology, and it's not completely related to the visual cortex. In other words, there is a part of our sight that is non-visual, so to speak. That's why we can perceive completely different things as the same thing. The simplistic drawing of a helicopter and an actual helicopter are both helicopters. Going back to the analogy between price action and a text, we can use the same dynamic resolution mechanics to perceive a few interesting patterns. In a text, we have letters. Letters form words. Words form sentences. Sentences form phrases. Phrases form paragraphs. Paragraphs form pages. Pages form the whole text or the whole book. That's going from the highest level of resolution to the lowest. The essential point here is that the higher the level of resolution, the more objective things get, and the lower the level of resolution, the more subjective it gets. It logically follows that there is a certain depth to a text or book, and the same thing happens to price. The interesting thing is that nobody disagrees about what a single letter means, assuming we are talking about the same language. However, once you combine a few of them, things start to get more complicated. For example, the same exact combination of letters can mean different things. These are called homographs. For example, the word nails can refer to the stuff at the tip of your fingers, or it can be the metal object you beat with a hammer to put stuff together. Once again, the answer to finding the correct meaning of a word is by using the context around it, just like we tend to do in price action. The alphabet of price has only 4 letters. The OHLC values, metaphorically speaking. These are objective and numerical values that represent a market at specific moments of a candle formation. It's impossible to disagree about what these values are, but we can certainly disagree about what they mean. For example, we can say that the high of a candle is X, but determining what this number means is a whole different problem. In that sense, the letters of price are always the same, but the physical and temporal distance between them in the 2 axes of a price chart is what is going to determine the story of price. The nice thing about a price chart is that it is a visual way of seeing the market, which is a lot different than seeing a table containing these values organized in numbers. It would be a lot harder to see patterns that way. Just like a certain combination of letters form a word in a normal text, the combination of OHLC values form a candle. The difference here is obviously not how the letters are arranged, but the spatial temporal discrepancy between them. This is what is going to create those notions of volatility in candles, and the nuanced relationships of the tails with the candle body. When we talk about one candle alone, we don't have to worry about the temporal dimension of a chart. We only worry at the spatial dimension of the y-axis. Rather intuitively, when we look at more than one candle, then the x-axis, or the temporal axis of the chart comes into play, and the relationship between candles begins to get less objective and more subjective. At this point we can start to form a story about how the candles relate to each other. If we look at a combination of candles bluntly, we can say that it is just a combination of numbers plotted on a Cartesian graph, but we can infer intention behind candles by looking at how these numbers behave geometrically. That's the absolute core of price action reading. This is the notion out of which everything else spirals. Part of the reason we can infer intention behind these numbers comes from the fact that these numbers reflect human behavior. We not only have tools to identify human behavior cues, but we also have tools to identify market edges that work independently of folk wisdom about standard technical analysis. To bring this whole discussion to a conclusion, I would like to grab your attention to the idea of optimal resolutions in price action reading. This is a subtle idea, but if you have been reading price action for a while, I'm sure you will find resonance with it. As we saw previously, we can view the market in the highest resolution possible, which is not good because that would be like trying to trade just by looking at each candle individually. There would be no context. We can also view the market in an extreme low resolution where we zoom out the chart as far as possible. That's obviously not good because we would not be able to see nuances. The conclusion that follows is that there is an optimal range between the 2 extremes of the spectrum of market resolution. That's close enough to see nuances and far enough to see the context. That's the origin of the guideline that tells you to look at about 100 to 200 candles in the chart. As you can see, there is a quite profound philosophical discussion behind simple rules like that, and it is important to be exposed to this kind of thing so we can trust it more securely. In this lecture we are going to study a trade in the Euro 1 hour timeframe. This trade involves the confluence of standard and pendulum pitchforks to display a probable area of reversal in price. From number 1 to number 3, we can see price creating a higher high, and therefore, rendering low number 2 as a solid market structure. Inside our methodology that implies the idea of uptrend in a general sense, but we have to investigate other details about the market to make sure that's the case. Notice that in the market vector between numbers 2 and 3, I highlighted with a green circle the lower tail of a candle that seems to shoot out of the supply and demand area. That seems to be an important point out of which buyers won the battle against sellers, at least in that point in time. In the highs number 3 and number 5 something interesting happens. Notice that in number 5 price pokes the absolute level of high number 3 about 4 times in a row. Since we are not dealing with market manipulation in this course, I will gloss over the possible interpretations of that movement. In the Newtonian trading strategy, we should look for other details. For example, the fact that price did not close above the high number 3 means that low number 4 is a fake structure. That movement between numbers 3 and 5 also seems to be in a minor flow, unlike the movement between numbers 1 and 3 for example. Between the numbers 5 and 6 we can see that price breaks the apparently fake low number 4. That seems to be a turning point for the downside, but it is still too early to tell at this point if we are going to talk about the major flow. Once again, in the market maker strategy, we can obtain a nice trade from number 5 to number 6 without too much problem. A few candles after high number 5 it's already possible to draw the fork number 1, which is the larger fork with the thinner black line. Let me grab your attention to important details in here that will confirm the validity of the pitchfork. This fork number 1 was drawn using the high number 1 as the A pivot, the low number 2 as the B pivot, and the high number 5 as the C pivot. Those were the 3 major points in price up to number 5. Observe carefully how the tip of the tail in this pitchfork catches a small frequency in the high number 1. Notice also how the same thing happens in low number 6. This is a pitchfork in tune with price action. Remember that this fork could be drawn a few candles after the high number 5, so the low number 6 is theoretically predictable. Moving the analysis forward, we can see that even though there is some probable degree of manipulation in high number 5, it creates a new high. Price hitting the centerline of fork number 1 as it did in low number 6 is analogous to sellers fully exhausting their energy. This is a pitchfork measuring the past of buyers to project the future of sellers in a rough sense. Right after low number 6, buyers enter the stage and start to pick the market up until number 7. Notice that the absolute high number 7 coincides with the high number 5. In number 7 we also have a fractal candle going down with some degree of violence showing that there are indeed some sellers at that level. From number 7 onwards price begins to drop, and this is where we can draw the second fork with a thick red line. Notice that this second fork is also using major points in the chart. The interesting things here is that fork number 1, the fork number 2, and the supply and demand line from the beginning of the analysis are all intersecting in the same area of the chart. In other words, there are 3 indications that price will indeed stop there and reverse to the upside. Notice how right after number 6 price spikes and touches the tail of the pitchfork number 2. That's another indication of symmetry. The trade you see in the chart was opened at the open of the candle marked by the green arrow, right after price created an inside candle after the triple intersection. The stop loss was placed below the low point of the candle that touched the supply and demand line. The target will be dynamic, and it will follow the upper and outer line of the blue upsloping pitchfork, which sees the market between numbers 2 and 8 as one vector up and one vector down. Let's see how the market develops. Here you can see how the pitchfork can be a precision tool. Price shot upwards after number 8, and it went straight to the outer and upper line of the blue pitchfork pointing upwards. Observe how accurately price touches the line 2 times as it is shown by the black squares. In this live trade example, we are going to take a look at a classic trade idea using pitchforks as the main technique. The trade happened in the Australian dollar versus the US dollar in the 4-hour time frame. Hopefully you will be able to notice how these techniques are transposable to any market and any timeframe. Once again, this attribute can only be real because these strategies touch on the fundamental drivers of all markets instead of working on the superficial peculiarities of each market. Here we can clearly see a lower high and a lower low being formed in the number 2 and 3 respectively. For all intents and purposes that means we are in a downtrend. We also have the formation of a solid market structure in the high number 2. When the market produces a lower high and a lower low, we have the dominance of sellers as a rule. If you remember the review about Newtonian physics that we did in the theoretical lectures of this course, you will see how this market will tend to continue in a downtrend. In other words, following Newton's first law, we can say that if the market is indeed in a downtrend, it tends to continue in a downtrend until an external force intervenes. Along with the creation of a solid market structure in number 2, we also have an ignition line, which is drawn based on the interpretation of where sellers really decided to take control of the market after high number 2. Observe that this ignition line is completely different than the absolute high number 2. Absolute highs and lows are really easy to pinpoint, but in order to see an ignition line, we have to read price action more carefully. In other words, if you take a closer look at those two black arrows pointing down after high number 2, you will observe price creates a horizontal frequency across 4 different candles until the market finally gives up and explodes down in a large bearish candle. This is called an ignition point precisely because it shows the moment where sellers won the battle and started exhausting their energy to the downside. The good thing about these lines is that price has a memory in relationship to them, and they will often be tested again in the future. That's exactly what happens in number 4. Price creates a lower low in number 3, and then it comes back to test the ignition point. Observe that it pierces the ignition line and it closes below that level, which is a sign that the market is still respecting the sellers from number 2. We also have the creation of an inside candle right after candle 4, which is a sign that the market is indeed deaccelerating. Once we have these pieces of evidence showing that price is still respecting the sellers from number 2, we can assume that the market will continue following Newton's first law of motion. This is exactly the point where we can look for significant places to draw a meaningful pitchfork. The standard fork you see in this chart was drawn using the highest high on the chart, low number 3, and high number 4. There are important details in here. Take a look at how the fork tail catches the small frequency at the highest high in the chart. Remember that this fork was drawn after number 4 and before number 5. The trade you see in the chart was triggered when price hit the outer line of the fork. Notice how the outer line of the fork intersects with the horizontal ignition line almost exactly where price touched it and reversed in number 5. That's almost a perfect example of the fork catching a market edge, which is the high number 5. The stop loss for this trade is a no-brainer. The most logical location to place the stop order is above the high number 2, which is going to act as some sort of barrier if the sellers on which we are counting hold their strength. The target is a little more complicated if you are looking to be precise in trades like these. This is one of the examples where we can make use of the auxiliary lines of a pitchfork. Observe that in number 5, which is the key moment of this trade, price pierces the outer line of the fork by a few pips. That's a frequency shift happening in a market edge. We can draw an overthrowing sliding line taking advantage of the absolute high produced by the frequency shift. If we follow Newton's third law of motion, the action of the overthrowing line in the past will produce an equal and opposite underthrowing reaction in the future, which is marked by the lower sliding line in the opposite outer line of the pitchfork. We can use this lower underthrowing line as a dynamic target for our trade. In other words, since we are in a short trade, and the pitchfork is sloping downwards, the longer we are exposed in the market, the more we will be rewarded. Let's see how the market develops. Here we can see that price reached the underthrowing sliding line. Observe how price touches the line but it never violates it by always closing above the line. Observe also how price touches the upper and outer line of the pitchfork precisely. This is a good example of a fork being in tune with the underlying market frequencies. As you can see, this type of trading can be extremely precise. In this video we are going to study a short trade idea in the US dollar versus the Canadian dollar in the 15-minute timeframe. This trade is relatively simple, and the interesting thing about it is the counterpoint between the major and minor flows of price. It's also interesting to observe how the pitchfork will unite both flows together. Observe also that we always start the analysis by counting highs and lows and identifying supply and demand zones. The line work comes only after. In this chart is clear that in number 1 to number 4 we have price making lower highs and lower lows. Once again, this means downtrend for us in a general sense, but we cannot forget that the market is not always that simple. We still have to find points in the chart where techniques converge. We cannot simply open trades because we identified the flow going in one direction or another. We still have the problem of identifying the correct location of trades. Number 4 is a low that surpassed the low number 2, so we can consider high number 3 as a solid structure since sellers were able to prove themselves to be stronger than buyers in that vector. Along with the notion of solid structure, we also get a supply and demand zone near each solid structure. This represents the area where one of the players gave up entirely, which is a lot different than the absolute high or low of the movement. To identify these supply and demand zones we have to look for clues in price action near the highs and lows. For example, in high number 3 we have a series of upper tails that seem to be cutting the same line. That's a good area to place the limits of the zone. These zones can be rough estimations or a precise line. The most important thing is to pinpoint an area where a market player is likely to appear again because it has appeared in the recent past. After number 4 we can see that sellers completely exhausted their energy, and buyers assumed the control of the market. Price starts to rise and go in the direction of the supply and demand zone found in number 3. In number 5 we can see that price reaches that area, and it does not violate the high number 3. After number 5, price starts to create a minor flow downwards, which confirms the validity of the supply and demand zone. Notice how numbers 5 through 9 form a small flow downwards. The interesting thing here is that those descending highs and lows also form little supply and demand zones of their own. This is where we can begin the line work to pinpoint exact areas to trigger a trade. It's pretty clear at this point that high number 3, the low number 4, and the high number 5 are the 3 alternating pivots that can be used to draw a major standard pitchfork. Notice how the tip of the pitchfork's tail catches the frequency at the absolute high number 3. This is another small detail to add contextually to the analysis, and it serves to confirm that this pitchfork is indeed in tune with the current market. The key point of the trade you see in this chart is being able to see the downward frequency line that is also a sliding line of the major pitchfork we have in the chart. Observe that between number 7 and a few candles after number 9, price respected that downward frequency by touching the line without violating it about 10 times. That's the sign of a strong frequency that is more easily displayed by finding the angle of this market first, and that is only unveiled by drawing pitchforks in major alternating pivots. The stop loss for this trade was placed above the high number 5 so we can take advantage of the extra protection given by proven sellers in the chart. The target of this trade will be placed in the lowest and outer line of the pitchfork so we can aim for a 1 to 3 risk-reward trade. Let's see how the market developed. Observe how price reaches the lowest line of the pitchfork precisely, and then it immediately reverses. This is once again the power of knowing how to draw meaningful lines that have scientific substance to sustain them. It's virtually impossible to reach this level of precision by using folk wisdom about technical analysis. Only by layering the scientific view of price we can achieve the best results and gain a real edge over the other traders. In this lesson we are going to study a live trade idea in the British pound versus the US dollar in the 30-minute timeframe. This is a rather simple trade making use of standard pitchforks, supply and demand, and the overall idea of trend identification using the relationship between highs and lows. The only subtlety regarding this trade relates to the sensitive perception about the major and minor flows. You will often notice that this perception is one of the hardest things in trading. From number 1 to number 3 I drew a major standard pitchfork using the most prominent alternating price extremes in the chart. Observe that after number 3, price starts to flow downward in the minor framework instead of continuing the major flow found by the pitchfork. That's an interesting thing to observe, and there are a few considerations that can be made in here. Even though price can shift between major and minor flows like that, price will tend to respect meaningful lines. In other words, we can use lines found in the major flow to take trades that are derived from the minor flow. If you look carefully in this chart, you will notice that between numbers 4 and 5 a minor flow is established. You will also notice that near the outer line of the pitchfork, we can see a point of ignition marked by the candle number 6. This implies two things for us. The first is that this fork seems to be in fact catching some sort of market frequency. The second is that we have a rough idea of where these minor sellers will be seating if price returns to that level. Starting from low number 4, we can draw a horizontal support and resistance line. Notice how the line goes from support in number 4 to resistance in number 7. We can also draw the upper limit of a potential supply and demand zone using the turning point right before the ignition downwards. Observe that in number 9 price tests the outer line of the fork 2 times, and then it starts to go down. As a parenthesis, if you are aware of the fractal flow method as well, in candle 9 we would be able to see a very clear fractal candle, which would add a lot of weight to this short trade idea. As I said in the beginning, this is a relatively simple trade idea because we are using the combination of a standard pitchfork in alignment with a support and resistance line that has been switched, and a supply and demand line that spirals from an ignition point in the chart. From that point in the analysis, a short trade was opened at the second time price touched the outer line of the fork in number 9. The logical place to put a stop loss is in number 5, which is the minor confirmed market structure. The logical target for this trade would be the lowest line of the pitchfork, which also seems to correlate in some way with the lowest low in the lower left corner of the chart. Let's see how the trade turns out. Here you can see that our short trade idea hit its target in the lowest line of the pitchfork, but I want you to pay attention to a much subtler detail in the chart, which is the expansion of price action in relation to the pitchfork. Notice that in number 8 and number 9 price expands around the lines of the pitchfork. This is one of those cases where an overthrow can cause another overthrow. Observe how the exact same thing happens between number 9 and the price extreme that hit our target. In other words, if you wanted to be even more precise in this trade, you could use the subtle hint about the market expansion in numbers 8 and 9 to project an overthrowing sliding line outside the lowest line of the pitchfork. This serves for us to see how there is a lot more to these lines than what meets the eye, so paying close attention is always a good idea. In this lesson we are going to study a situation that is not so common, but it can certainly happen if you pay close attention. We are going to see an example of a reverse pitchfork in combination with a pendulum pitchfork in the Canadian dollar versus the Japanese yen in the 15-minute timeframe. Pay close attention here to the subtleties between the major and minor flows and notice how the relationship between buyers and sellers never stops shifting. In this chart you can see that I drew a very large upward sloping standard pitchfork using the alternating price extremes labeled from number 1 through number 3. That also represents the major flow of this particular piece of price action we have in sight. Notice that after low number 3, price begins to rise in a minor flow structure as you can observe with the numbers 4 through 6. The original A-axis of the large pitchfork you see was placed in number 1 as this was originally a standard pitchfork. However, after price began forming a minor flow between number 4 and number 6, the A-axis of the pitchfork was tuned to the frequency running along the upper tails as it is shown in the red arrows pointing down. Notice that the center line was tuned to the frequency found in the tails, not to the absolute price extremes. Technically speaking, this large standard fork was transformed into a reverse pitchfork once the center line was tuned to a price extreme after the C-axis. This tends to give us the opportunity to look for specific market edges using the other lines of the fork, assuming we have converging elements to the same price level. This is exactly what happens in number 7. Let's take a moment and unpack all the details contained in number 7. Observe first that in candle 7, price pierces the low number 5, but it doesn't close below the level of low 5. That gives margin to price interpretation under the market maker strategy, but we are not going down that road in this course. The important thing here is that price pierced the line and rejected it. The second thing we should observe is that the exact same thing happened with the outer line of the reverse pitchfork. Notice also that there is a second pitchfork going down in this chart, and it was drawn using minor highs and lows that are relevant to price action previous to number 7. Observe that at one point price pierces the lower line of this small fork, creating a frequency shift that can be extrapolated in the future using a sliding line. Look at how this sliding line intersects exactly where price pierced the horizontal line from number 5 and the lower line of the major reverse pitchfork. This is a perfect triple intersection of 3 different lines, and it happened near low number 5, which is a solid minor structure that can be used as a place to put a stop-loss order. The trade you see opened in the chart was triggered when price touched the triple intersection point for the second time, as it is displayed in the green arrow pointing upwards. Since we have a reverse fork apparently catching the frequency running along the upper tails, it seems logical to place a target order in the center line of the reverse pitchfork. Let's see how the trade develops. Notice how the reverse pitchfork continues to pinpoint market edges in the near future and provides an incredibly accurate place to get out of the long position, as it is shown in the red square. Observe also the importance of the principle of reverse engineering of market contexts. As I said previously in the theoretical lessons of the course, there is an infinite amount of meaningful lines that can be drawn in the chart. For that reason, we must look for places where several meaningful lines intersect and align that with the contextual elements that tell the story between buyers and sellers. This is the only way of seeing high-quality trade opportunities, and that's precisely what sets the professionals apart from the beginners. In this video we are going to study an interesting trade that happened in the euro versus the Japanese yen in the 30-minute timeframe. This is once again an excellent demonstration of how pitchfork lines can reveal the underlying market angles and edges in an extremely accurate way. Let me remind you once again that this incredible accuracy is not a mere accident born out of arbitrary rules of the pitchfork. Pitchfork lines are meaningful because they have a scientific rearguard. In the market vectors between numbers 1 and 3, we can see price creating a higher high and a higher low in what is clearly the major flow of this market. After high number 3, it's already possible to draw the downward sloping pendulum pitchfork that has thin lines using high number 1, low number 2, and high number 3 as the alternating pivots. Notice that this pitchfork does its job pretty well and catches the next reversal point in number 4 with its center line. Observe also that in number 4 there is a slight frequency shift to the downside of the center line in an overthrowing fashion. Immediately after low number 4, it's already possible to draw the upward sloping pitchfork with the thicker lines. Observe that this upward sloping pitchfork started as a standard fork, and then it was transformed to a modified fork by grounding its A-axis in the midpoint of the AB segment. The reason this upward sloping pitchfork was transformed into a modified fork was precisely because of the principle of reverse engineering of market contexts. In other words, since low number 4, it was already possible to imagine a price reversal around the upper line of the pendulum fork, especially with the frequency shift. By purposefully finding lines that intersect in suggestive places, we can reverse engineer a possible meaningful linework. Notice how these pitchfork lines intersect in candle number 5 almost perfectly. However, you must be careful with this sort of thing because you will have the impulse to trigger trades every time you see lines intersecting like that, and I can already tell you that this will not work. This linework is just one part of the analysis, and you can only act accordingly when other elements come together to support the main idea of the lines. For example, a trader has to wonder what is going on in the battle between buyers and sellers. If we look at this chart, in a first moment we will assume that buyers have the advantage, and they certainly might. However, in financial speculation we always have to pay attention to both sides of the market, and often you will find that you can come to contradictory and ambiguous conclusions. One good example is the subtle flow shifts that can happen. If reading the trend was completely straightforward, trading would be a lot simpler. For example, we see that low number 2 is a solid major structure, but we can also see that price is not near to that point. In other words, the overall trend is indeed upwards, but price still has headroom to go lower. It's not just because price hit the center line of a fork that it is bound to go higher. Things are not that simple in trading. Notice that after candle 5 hit the double intersection of those pitchfork lines, it created an inside candle. That was the key piece of information to trigger this trade to the downside. Pay close attention to the overall context. We have a perfectly reasonable linework, we have a lot of headroom for the market to go down, and we are seeing signs that price is indeed stopping at the linework we have encountered. The short trade you see in the chart was triggered at the open of the candle right next to the inside candle as it is marked by the red arrow. The stop was placed a few pips above the high number 3, which represents the birthplace of the significant sellers who created the vector between 3 and 4. The logical target seems to be the lower line of the pendulum fork, so we can have at least a 1-to-3 risk-reward ratio in this trade. Let's see how the trade progresses. Here we can see that the short trade hit its dynamic target in the lower line of the larger pendulum pitchfork. In this lesson we are going to study a short trade idea in the Euro-dollar 30-minute timeframe. This type of trade is pretty common in all markets, and it dwells in the middle of the spectrum of beginner to advanced application of professional techniques. Once again, we are going to start the analysis by looking at what the major flow is doing. We usually do that by counting highs and lows. Here we can see that between number 1 and number 5, price has been producing a clear downward movement, which is identified by noticing the lower highs and lower lows. When we have a market that looks relatively clean like that, we usually say that it is flowing naturally without too much noise or intervention. Beyond the major flow, we also have to be aware of what the minor flow is doing. Observe carefully what happens between high number 4 and low number 5. We have the clear development and display of the minor flow of this market. One of the most difficult things in trading is being able to put the major and minor flows in the correct perspective. This is not easy because these flows are living mechanisms, so they appear and disappear, shift volatility constantly, and invert their positions in their internal hierarchy of importance. Observe the difference between the market vector between number 4 and 5, and the vector between number 2 and 3. This is the sort of detail that an experienced trader must pay attention to. By noticing the appearance of the minor flow in a more prominent manner, we can make the assumption that minor highs and lows will have some sort of utility at the same time that we take into consideration the major perspective as well. Observe what happens between the numbers 6 and 9. We have a minor expanding formation. In other words, a higher high followed by a lower low. Expanding formations like that can be confusing, but in this case they tell a different story because of where it appeared. As you can see in the chart, I drew a black pendulum pitchfork with thin lines. Notice how high number 8 touches the center line of that fork and proceeds to create the other expanding leg of the formation in number 9. There are other interesting details here that help enrich the analysis. The first detail is that we have a downtrend and a pendulum pitchfork sloping downwards. If you remember the theoretical lectures, you will recall that pendulum forks are usually angled against the trend. The conclusion is that when we have a pendulum fork that agrees with the overall angle of the trend, we can assume the trend has an unusually high level of force. The other detail we can see in here is the frequency along the tails of the large pendulum fork as it is marked by the 3 green arrows. Observe how the center line of this large pendulum fork acts as a sloped support line around those tail frequencies, and then price shifts and starts treating it like resistance near the expanding price formation between number 6 and 9. Needless to say, this geometrical relationship can only be observed in this way through the lens of pitchforks. There is another important detail in the expanding formation that is subtle and yet really important to the trade opportunity in question. Notice that the vector between number 8 and 9 is a complete denial of the buyer's attempt to bring the market up in the vector between 7 and 8. The contextualization layer that can be added on top of that is the fact that high number 8 is happening in the center line of our major pendulum fork. This intricate relationship between price action reading and the geometrical lines of the pitchfork suggests that high number 8 can become a major high, and price will continue to move down after that. It logically follows that we can try to find a way to get in this market in the most accurate way possible. This is where the downward sloping red standard pitchfork with thicker lines comes into play in this trade. Observe that this red fork is drawn using high number 4, the low number 5, and the potential high number 8. This is one of the difficult things about trading with pitchforks in real time. Oftentimes you will have to assume that the C-axis of the pitchfork in question is indeed placed in an important level. We don't know that for sure at this point, but we can assume that this is going to be the case based on the contextual analysis we have so far. There are also a few interesting details about this pitchfork in particular. Observe that it fulfills its job of projecting a price exhaustion in the center line, which happened in low number 9. It also cuts through low number 7 in a clear way. The outer and higher line of the red pitchfork is also pointing to the same area that our proven pendulum fork previously pointed. The fact that price came back to the outer line in number 10 is an indication that a trade entry is possible. Beyond all of that, we can draw a horizontal line coming out of high number 6, which also cuts through the same level as the center line of the black pendulum fork and the outer line of the red standard pitchfork. This horizontal line can be interpreted in the following sense. When price went above high number 6 as it did in number 8, buyers ran into more powerful sellers. This would perfectly explain the vector between 8 and 9. In other words, the vector between 8 and 9 is a disapproval of the high number 6, and since the market has a short-term memory, that level can still be useful if it is combined with other contextual elements. This small horizontal line also cuts through the same area in the chart that we have been talking about the entire analysis. The trade you see opened in the chart was opened when price touched the outer line of the red fork in number 10. The stop loss was placed a few pips above the high number 8 since it appears to be a rejection even though it is a minor one. The target for this trade will follow the outer and lower line of the red fork as a dynamic target, so our risk-reward ratio increases along with the time of exposure in the market. Let's see how price develops. Here we can see that our short trade was successful because price touched the lower and outer line of the red fork as it is shown in the red square. Observe that the red pitchfork is what enabled the entry and the exit of this trade. This is not a rule of course, but it is an interesting observation of how one fork can precisely give both entry and exit points of a trade. In this lesson we will take a look at a long trade idea in the US dollar versus the Japanese yen in the 15-minute timeframe. This is another very common trade you can find in any market and in any timeframe. As you may have noticed already, the Newtonian trading strategy can manifest itself in countless market scenarios. There are too many possibilities of combinations of lines and market contexts. This is the reason we must get used to the way the analysis works instead of memorizing what the setups are. If we analyze the major flow of this market in particular, we are going to see that price is gently producing higher highs and higher lows. In other words, each high is just a little bit higher than the previous high, and each low is just a little bit higher than the previous low. Pitchforks tend to work extremely well in conditions like these. Observe that high number 4 is just a little higher than high number 2. Pitchforks tend to work better when this happens because their angles can be drawn in an optimized way without getting too steep. As I said in the beginning, the main idea behind the trade you see in this chart is quite simple. Notice that high number 4 surpasses the high number 2, and this movement renders low number 3 as a solid market structure. That means we can derive a supply and demand line from the frequencies in the lower tails surrounding low number 3. We can also draw a pitchfork using high number 2, low number 3, and high number 4 as the three alternating market extremes. Notice how price action lands exactly at the center line of the black down-sloping pitchfork in number 5. That's an accurate prediction of a market extreme that could be made right after high number 4. This is what I meant when I said that pitchforks tend to work extremely well in markets with gentle trends. The notion that we have an uptrend added to the fact that price landed in the center line of a pitchfork, which also happened to occur in a supply and demand line, could be enough to trigger a long trade with a stop below number 3. However, sometimes you can miss trades like these for whatever reason, so I will show you how you can pinpoint a secondary entry using pitchforks. Assuming that low number 5 will be a major low due to its position in relation to the supply and demand zone and the center line of the black fork, we can draw another pitchfork to display the next market edges that might be useful to optimize this secondary entry. Observe that after number 5, price begins to create a minor flow to the upside. That's a good indication that low number 5 was indeed significant. Between numbers 6 and 8, price creates a minor solid structure and a minor ignition point that under the fractal flow method could be interpreted as an outside fractal candle. Observe that in number 9, price goes back to the minor ignition point, which happens to be at the outer line of the orange pitchfork. In other words, this is a secondary entry point using a double intersection using the combination of major and minor flows and its more relevant elements. The trade you see opened in the chart was triggered when price hit the upward line of the pitchfork in number 9 as it is marked by the green arrow. The stop loss was placed a few pips below low number 5 since it seems to be a potential major low at this point in time. The target for this trade will be at the highest line of the orange upsloping pitchfork for a dynamic target. Let's see how this trade turns out. As you can see in here, price hit the highest line of the orange pitchfork, rendering our trade successful. Notice also that the use of the dynamic target following the line of the fork enabled this trade to start with a 1 to 3.7 risk-reward ratio and end with a 1 to 5 risk-reward ratio, which is more than enough to call this trade a successful one. Just imagine that by winning a trade like this, you can be wrong for the next 5 trades and still break even. In this lesson we will study a short trade idea in the US dollar versus the Swiss franc in the 4-hour timeframe. This is also a textbook example of how frequency expansion works within a pitchfork, and how we can use sliding lines to mark price edges quite accurately. We will also take a look at an interesting application of mirror lines, which is a rare analytical tool, but still useful to observe the symmetry of price. As you can see, this chart is packed with details and lines, so let's build the analysis from the ground up for a better understanding. The first important detail in here is the market vector between number 1 and number 2. That can be classified as a major market movement, and the origin of this movement in number 1 is definitely important since it gave birth to this volatile vector. Between number 2 and number 4, we can see that price creates a retracement in number 3, and then it attempts to break high number 2 in number 4. Observe that I drew a horizontal line coming out of the high number 2, which is the line labeled as the axis of the mirror lines. Before I explain the mirror lines that are drawn, you should first notice that high number 4 only pokes high number 2. Observe that there is an upsloping line labeled angle of upper tails connecting the absolute high of number 2 with the absolute high of number 4. This creates an angle in relation to the axis of mirror lines, so to create the actual mirror line, we only invert this angle to the downside of the horizontal axis line. By doing that we generate the down-sloping line labeled as the mirror line. Observe what happens between number 4 and number 6. Price pokes the high number 2 in number 4, and then it comes back down to create low number 5. Notice how the mirror line catches the upper tail of high number 6. I also drew a mirror line with a small frequency shift, which is the thicker line right above the standard mirror line. Observe how this shifted mirror line describes the tail frequencies around high number 4, and how it catches the upper tail of candle 6 even more accurately. In candle 6 we can also see that the upper tail is unusually large, meaning that sellers are indeed increasing their power in this market. That doesn't necessarily mean that buyers have been overpowered, but it certainly means that we better pay attention to both players. The market vector between number 6 and number 7 violates the low number 3 and low number 5. There is even a small gap down in the middle of that vector. These subtle and apparently tiny details are what helps form the overall context of our trade. If you train your mind to take this sort of thing into consideration, you will definitely become a better trader. Right after number 6, we can already draw the down-sloping pitchfork you see in the chart using high number 2, low number 3, and high number 6, which are all relevant market extremes. One interesting detail about this fork is that we can observe a frequency expansion happening. The delta between the center line of the fork and low number 5 creates an overthrowing movement that is duplicated to the tail of candle number 6. Between number 5 and number 7 we have the consolidation of high number 6 as a solid structure, and we also have a turning point line, which is one of the ways we have to pinpoint where a market player might appear again. The trade you see in this chart revolves around what happened in number 8. Observe that we have price going to the intersection point between the sliding line and the turning point line. We also have the broader notion that sellers can be in complete command of this market, at least until low number 1, which is the birthplace of the important buyers we need to worry about. The trade you see in the chart was triggered when price touched the sliding line for the second time in number 8, which is the double intersection point. Since high number 6 seems to be too far away, the stop was placed a few pips above number 8. Needless to say, this is a more aggressive stop loss that relies completely in the accuracy of our double intersection point that triggered the trade in the first place. The target for the trade is the low number 1, which seems to intersect nicely with the pitchfork lines. If we imagine price going down, we can see that price can easily reverse at those intersections. Let's see how this trade turns out. Here we can see that price reaches the level of low number 1, rendering our trade as a winner. Observe that there is a lot more to what meets the eye when it comes to simple highs and lows. The market has hidden geometrical patterns that can help the wise trader to be incredibly accurate. Hopefully you will be able to appreciate the power of these lines. In this live trade example, we are going to study a short trade idea in the British pound versus the Australian dollar in the 1-hour timeframe. This is yet another great example of how pitchforks can work well in combination with simple trading principles like support and resistance lines. In this trade you will notice the subtle balance between the major and minor flows of the market. Observe the difference of the market vectors from number 1 to number 2, and from number 2 to number 3. The first vector up shows a strong and volatile movement. The second vector down shows the aftermath of the first vector. The minor flow is also a lot more pronounced inside the vector from number 2 to number 3. In number 1 we have a level in price that buyers might show up again in the future. The important thing to consider here is how strong these buyers will actually be in the future in relation to the sellers. That's always the main puzzle a trader must solve. The analysis starts to get narrow when price reaches number 3. We can clearly see that those buyers from number 1 are still in there, but we cannot say for sure if they are going to win over the minor flow going downwards that started in number 2. Beyond being an ambiguous situation, we also must take into consideration the hypothesis of a market flow paradox, which is when the minor flow trumps the major flow. If it wasn't for things like the flow paradox in price action, it would be a lot easier to spot the beginning and end of trends. This somehow touches on the heart of speculation, which is taking the risk even at the face of ambiguity. This is where the rest of analytical tools might help us spotting a good trade opportunity. Observe that there are two pitchforks drawn in this chart. The black downward sloping pitchfork catches the first market angle of the minor flow that started around number 2. Notice how the pitchfork seems to describe price on the way down pretty nicely. The other pitchfork is a pendulum fork which aims to show the probable reversal point and continuation of a trend. We also have a support and resistance line in this chart which has been switched from support to resistance. Observe how the two pitchforks and the support and resistance line intersect around the same area in number 4. Notice also that number 3 is an underthrowing frequency shift in relation to the downward sloping fork. By using Newton's third law, we can project an overthrowing sliding line in the opposite outer line of the black fork. Observe how accurately the upper tail of candle 4 touches the exact moment where the outer sliding line of the black fork intersects with the outer line of the green pendulum pitchfork. The trade you see opened in the chart was triggered at the open of the very next candle to number 4 as it is marked by the red arrow. The stop loss is an aggressive one because we are counting on the minor flow, in the double intersection of those two pitchforks, and in the resistance line as well, but we are not placing the stop above solid structure. The target was placed at the low sliding line of the black pitchfork. Let's see how the trade develops. Observe how the target is reached respecting the frequency shift found in number 3. This is a good example of how accurate trading can become if you understand the underlying nature and hidden geometry of the market. In this lesson I will show you a quick historical example of a width pitchfork and its incredible reliability. As you will notice across the course, the most common type of fork will be the standard, but that doesn't mean that there is no value in the other types of pitchforks as well. In this image you can see that I drew the number 1 through number 3 to pinpoint alternating highs and lows. That's the prerequisite to draw the standard pitchfork we have in this chart. If you remember the theoretical lectures of the course, you will recall that a width pitchfork can be drawn when you have a standard pitchfork, and price drifts away from the outer lines of the fork. The purpose of the width pitchfork is to incorporate this drift into the already existing standard pitchfork in order to adjust to the new price information. We do this by moving the C-pivot of the standard pitchfork to the outer portion of the price drift. In this case, the C-pivot of the pitchfork is in high number 3. Watch what happens when I move the C-pivot of the standard pitchfork from high number 3 to the peak of the price drift. Observe how the width pitchfork ends up describing price incredibly well, almost 80 candles in the future. In other words, a simple width fork drawn in major pivots, and respecting the price drift, was able to describe many price edges in the near future. That's the advantage of knowing how to draw these important lines. In this video I want to show you one more historical example of the amazing pitchfork symmetry and accuracy that can be found in the markets. Observe that I have a pendulum pitchfork drawn in this chart. As you may have noticed already by paying attention to the other examples, by modifying a pendulum fork you can obtain some interesting angles in favor of the trend. Watch what happens when I modify this fork. The down-sloping fork transformed into an up-sloping one, but notice that frequency contraction that is highlighted by the symmetrical underthrowing lines inside the modified pendulum pitchfork. Observe how the frequency contraction inside the pitchfork pinpoints the absolute high of this market. Note that the absolute high in this market is also a massive fractal candle under the light of the fractal flow method. We can draw another standard pitchfork using more recent data to highlight the other edges of this market after this absolute high. Watch what happens when I draw the second fork. The down-sloping fork is able to catch the very next edge of the market next to the absolute high marked by our fractal candle. Observe also how price respects the center line and the outer line of the pitchfork in question. In this quick demonstration, I want to show you how powerful market angles can be. This is a piece of price action of the New Zealand dollar versus the Japanese yen in the 1-hour timeframe. Observe how I drew an upsloping line connecting the lows marked by the green arrows. The low marked by the green box was an almost perfect prediction of the black line, but that's not exactly what I want to show you. Notice what happens when I duplicate this black line and place it at the high marked by the red arrow. As you can see, the same line with the exact same angle produced in the past lows is able to pinpoint exactly the highs in the future. This is a perfect example of the underlying market symmetry. Notice how the subtle relationship between simple highs and lows that are not apparently connected can give you the keys to seeing accurate market edges. In this historical example of the incredible geometrical relationships we can find with pitchforks, I want to show you an example of a modified fork. As you can see, I drew a downward fork using 3 alternating pivots in the chart. Observe that the angle of this fork is a little steep, and price seems to be drifting away from its center line. One of the things that we can do in these situations is to modify the fork by bringing its A-axis to the middle point of the AB segment as it is shown by the blue line. Watch what happens when I modify the fork. We can observe that the center line of the modified fork catches the price extreme that could not be seen using a standard fork. In this lesson I'm going to show you another example of pitchfork hidden symmetry in the euro versus the Norwegian krone 15-minute timeframe. In this chart you can see that I drew a normal pendulum fork, which is doing its job of projecting a price exhaustion in its center line. However, there is a lot more to pitchforks than what meets the eye, so observe what happens when I modify the pendulum pitchfork. By modifying the fork, we are able to catch several market edges, and by adding a double line to our modified pendulum fork we can also project the absolute high of this market with an incredible accuracy. Notice that this is an exotic currency pair, which shows once again how it really doesn't matter what market you apply these concepts. All markets are inherently the same. In this example I want to show you a good example of frequency shifting in the weekly chart of the euro versus the Canadian dollar. We have a standard pitchfork in this example, and it fulfills its task of pinpointing the probable path of exhaustion of price after the C-pivot. However, price changes its frequency when it reaches the center line as it is displayed by the red rectangle. In the technique of frequency shifting, we maintain the angles of the original pitchfork, but we adjust the frequency to the new price information with the goal of projecting more accurate levels of reversal in the future. Watch what happens when I adjust the frequency of the standard fork to the new price information inside the red rectangle. By adjusting the frequency of the standard fork, we would be able to forecast the next major high with an almost perfect level of accuracy. Keep in mind that this is the weekly chart, so the time distance between the frequency shift and the projected level is about 20 weeks. This once again proves the power of frequency shifting in pitchforks. In this short historical example of how pitchforks work in real life, I will show you a very explicit example of how the frequency along the tail of the pitchfork can be an indication of its validity. I will also show you a double line doing its job reasonably well. As you can see, this is a euro versus the British pound 1-hour chart. As I often say, the time frame and the market you trade is irrelevant. That's why I attempt to give you different examples in different situations. Observe carefully how price touches the tail of the standard pitchfork as it is shown by the red arrows. That definitely gives the impression that this market is indeed respecting the line of the pitchfork. As an extension, watch what happens when I place a double line on top of this fork. The double line is able to predict with a great level of accuracy the major high marked by the red rectangle. This shows once again how pitchforks are an effective way of projecting the future price movement using past price information. It displays the underlying angle and edges that are obvious, but not self-evident. In this lesson we are going to see an interesting historical example of price shifting its frequency back and forth between one of the lines of a standard pitchfork, and also how it is important to combine different types of forks to confirm reversal points in price. In this specific case, we are going to see a pendulum fork working against a standard fork. You will be able to see the incredible precision that these lines can give you once you understand how and when to draw them. As you can see in this chart, I drew a standard fork using numbers 1 through 3 as the pivots. Observe also that right after number 3, price violates the centerline of the fork and creates a frequency shift. Starting from the peak of this shift we can draw a sliding line to project a possible future price peak, which happened a few candles later as you can see. However, price can go back to the original frequency of the pitchfork as well. In the second green arrow, you can observe that price goes back to the frequency of the original center line of our standard downward sloping fork. In the next two red arrows, you can see that price respected the original frequency in both the outer line and in the center line of the major fork. Now I want to grab your attention to how we can make these lines even stronger by finding areas where lines of different types of forks intersect. I will draw a pendulum fork in one set of alternating pivots so you can see what I mean. Watch how the center line of the pendulum fork will also point precisely to a price extreme. Observe how lines from different forks intersect and predict a reversal in price. Remember that it's still a good idea to align this type of linework with the other elements of the analysis. Don't try to trade just using forks because they are a unidimensional technique despite their richness. Always attempt to trade using a multidimensional analysis. In this example I want to show you how modified pitchforks can also display hidden market angles and edges. Observe that I drew a standard pitchfork using 3 alternating pivots in the chart. There is nothing special about this fork in particular, but it does fulfill its job of projecting the price trajectory after the C point. However, I want to show you how we can find even more amazing market edges using the same fork. In this example I will modify the fork, and then I will add a double line to the modified fork. Watch what happens. Observe how accurately the double line of the modified fork catches those lows in price. This is a good example of the type of creativity you need to have with these lines, and the accuracy level you can achieve with them. In this historical price example, we will take a quick look at a standard pitchfork being transformed into a width pitchfork, and the incredible effect that this transformation can have in a chart analysis. Observe that we have a down-sloping fork in this chart, but price drifts away from the fork. This is the clue that leads us to think about a width fork instead of a standard one. Observe what happens when I move the C-axis of the standard fork to the outer region of the price drift. As you can see in here, the width pitchfork is able to catch a low price extreme with great accuracy in its center line. Observe also that this is the chart of the South African rand versus the Japanese yen, which is an extremely exotic currency pair. This serves to show how all markets follow the same basic principles and adhere to the same universal hidden geometry of highs and lows. In this video I want to show you how pitchforks and their inherent geometry work in any timeframe. In this chart you can see a 1-minute chart. Watch what happens when I draw a standard pitchfork using major alternating highs and lows in the chart. Observe how price respects the internal constraints of the fork, and also how the frequency shift in the beginning of the fork is able to give a more accurate projection in the future. As you can notice, pitchforks work in the exact same way since the monthly chart down to the 1-minute chart.